Good afternoon, everyone. My name is Dr. Heidi Meyer. I am the Interim Dean of the Monteahuja College of Business here at Cleveland State University. I am happy to welcome you to our second Cornerstone Speaker Series of 2023. Our topic today is activist investing. Serving as our moderator is Dr. Yinjie, or Victor Shen. Dr. Shen is an associate professor in the finance department here at Cleveland State. His most recent paper published in the Journal of Financial Economics posed the question, do activist hedge funds target female CEOs? His research interests include hedge fund activism, activist investing in general, bank loans, and more. We very much appreciate Dr. Shen serving as our moderator today, and I will now turn it over to him to introduce our distinguished speaker.
Thank you, Dr. Meyer, for the kind introduction. As Dr. Meyer mentioned, my name is Yinjie Shen. I usually also go by Victor, and I'm an associate professor of finance here at Cleveland State University. I'm very excited to be the moderator today for our session on activist investing. So a little bit brief on activist investing. So in the past 2 decades, activist investors have become a non-negligible market force. While some argue activist investors destroy long-term value for short-term gain, others believe they create value for firms and are an important form of external governance. Today, we have here with us Dr. Shohfi, financial economist at SEC's Division of Economic and Risk Analysis. Prior to his role at SEC, Dr. Shohfi was an assistant professor of accounting and finance at Rensselaer Polytechnic Institute. Dr. Shohfi's research has been published in top accounting and finance journals and focuses on fraud, investor behavior, disclosure, and capital markets. It is a great pleasure to have Tom with us today. So for today's session, Tom will first share his overall thoughts on the topic, followed by a short presentation from me on returns to activist investors and short-selling activism. After that, I will ask for Tom's insights on several specific issues, and finally, I will open the floor for questions from our audience. Thank you again, Tom, for joining us. The floor is now yours.
Thank you, Yinjie, and thank you, Dr. Meyer, for having me for this Cornerstone Speaker Series. I am very happy to present on shareholder activism, including some academic research, some practical considerations, and some movies that I'll speak about that are fun things to take a look at after the talk. Before I begin, I have to make absolutely positively clear that the words that I'm speaking are my own, and they are not the Commission's. So specifically, I'll read the disclaimer that the U.S. Securities and Exchange Commission disclaims responsibility for any private publication or statement of any SEC employer or commissioner, including myself. This presentation expresses my views and does not necessarily reflect those of the Commission, the commissioners, or other members of the staff. So that said, now we can talk about activism. And in this world of machine learning and AI and big data, we have so much technology and it's everywhere. But one of the things about activism is that it's not high tech. At least it isn't yet. And it's probably difficult to see how it would become high tech because it is more focused on operations of a company. It is driven by people's opinions, people's views. And this is a quote by Carl Icahn. If you're not familiar with Carl Icahn, he is a longtime activist investor. He runs Icahn Associates. You can buy their stock publicly. He basically said that some people get rich studying artificial intelligence, just like we spoke about. But me, I make money studying natural stupidity. What kind of stupidity is he referring to? He's referring to the stupidity of managers. Managers are the ones that you hire to run the company that you buy shares in. So you are the principal when you buy stock. And when you buy shares in Apple, you hire the agent, say Tim Cook, to look after your investment, to manage the day-to-day of the company. So you delegate authority to this manager, and he's supposed to do a good job for you. Makes decisions about buying and selling companies, capital structure, payout policy, who to hire, et cetera, et cetera. But the problem is that this isn't always perfect. and there can be conflicts of interest between the principal and the agent. And keep in mind, in the activist context, the activist investor is a principal, but they are not just sitting there passively and allowing the agent to do whatever they want. They're saying, look, there's some disconnect between my interests and what you're doing, and I'm going to find a way to be vocal about that and to take actions to fix it. So this is an important form of corporate governance. We think about corporate governance as being internal to the firm. There's a board of directors that monitors management and looks after shareholder interests. Activist investors are an external form of corporate governance that allows investors to make better on their investment when management isn't living up to the task. Now, I'll give you one example, and this is potentially one we could disagree on, but it'll demonstrate my point pretty clearly. So Meta was not always called Meta. It was called Facebook for a very long time. Facebook is a very profitable business. The advertising engine generates billions of dollars of free cash flow every single year for the company and its shareholders. But as you know, they have been pivoting and changing their strategy, and that's why they changed their name to Meta. They're focusing on things like the metaverse. And Mark Zuckerberg has invested billions of dollars into VR technology and metaverse platforms that he thinks will potentially increase shareholder value. But they're not right now. They're burning cash flow, and the main core business of Facebook is declining as user growth is plateauing. So one could argue as an activist investor, if I took a large stake in Facebook, say, well, Mark, why are you doing this Meta project? It's not really delivering benefits to shareholders. Is this some type of pet project, something that you're doing for yourself that is not necessarily for the benefit of shareholders? And this is a controversial example because, as I said, it could be that metaverse investments pay off in the long run for the company. You could think about more easily understandable conflicts from pet projects, such as the CEO investing in a vanity project. It's like they're going to commission someone to build a gigantic statue of themselves in front of the company's headquarters. That doesn't seem to enhance shareholder value. Or potentially using private planes as opposed to commercial airlines for business travel. Those are things that shareholders might not like because they take money out of the pockets of their shareholders' pockets, but they don't deliver any value. So these are the kind of things that activist investors are going to try and fix. They're going to say, I am recognizing that this company has this problem. I have the capital to take a large position in the company so that I can enact positive change. So when an activist investor acquires more than 5% of a firm, they file what's called a 13D, and they have to disclose their activist intentions, describe what their plan is, etc., basically declaring that they are an activist. And whenever this happens, on average, there are positive returns to shareholders. So shareholders like this. They see a company as improving because of the things that activist investors can do to correct management's course. Now, there are internal governance mechanisms that managers use that fight against activism, including poison pills. A poison pill can dilute a single investor, an activist investor, by basically making their shares worth less the more they acquire. This was something that was threatened against Elon Musk before he bought Tesla. You can also have dual class share structures where you have one share that's publicly traded that has no or lower voting rights than a privately traded share. So these things prevent activist investors from accomplishing their task. So these things are considered negative for shareholders because they don't give an opportunity to an activist investor to fix a company when it potentially has these problems. So there are lots of different ways in which companies can be broken besides pet projects. And for those who are interested in the academic literature, this Brav, Zhang, Portnoy, and Thomas 2008 Journal of Finance paper, which is now 15 years old, is the seminal paper that discusses hedge fund activism. And they lay out objectives and tactics of activist investors. And not surprising, the most common objective for activist shareholders is just to increase value. So their argument is your stock price is too low, we just want to get it up. We don't have a specific reason why, we just think that you're underperforming. But there are others that can be more straightforward, more simple, including capital structure, such as if a firm is underlevered, they're not taking up enough debt, that the activist investor says, well, why don't you take on debt and buy back shares and capitalize on a lower cost of capital for debt? And this is something that Carl Icahn actually did with Apple Computer a number of years ago. And Apple issued a large amount of debt, bought back billions and billions of dollars of shares, and that's improved their performance as they've continued to do well in the future. There can be other objectives that are specific to individual activities. So they could be selling the company, making an acquisition, or changing focus by splitting off parts of the company. So for example, in the case of Meta, an activist investor could buy the stock and say it's undervalued because you have this bad combination of the metaverse and Facebook. So why don't you spin off Meta with some cash and let it spend money on investments in VR, and we'll just get access to the Facebook cash machine so we can have exactly the components that we want, and hopefully the individual components be worth more than the whole put together that potentially is not generating any synergies. Others can be governance objectives, such as getting rid of management, rescinding those takeover defenses, including poison pills, and reducing executive compensation. And I'll talk about that later when I give you an example from a movie. So these have been well codified in the past, and they provide a good structure to determine how exactly an activist investor is going about their business. Now, the tactics are various. One of the most common tactics is just to communicate with the board and management. So that could be, say, sending a letter, right? Like Elliott Management sent this letter to Western Digital Corporation last year requesting that they do things to improve financial value. So sometimes there's not actually any action being taken, just saying, listen to me, I know what I'm talking about, I've delivered value for my investors, and I want to help turn this company around, but if you take my suggestions, you'll be more successful at that. But there can be action as well, including launching a proxy contest to get board seats. So activist investors often take board seats on these companies to make changes that way, to make changes through internal governance for the company. They can sue the company. They can try and take control of the company. But either way, these various tactics have various costs. So writing a letter is very inexpensive. It's just a matter of typing it up and emailing it to management, emailing it to the board, emailing it to other shareholders. Launching a proxy fight to get board representation is far more expensive. It requires legal channels, and those are not free. Whenever I talk about a specific investment strategy, I always like to give examples of specific funds that engage in this type of activity. And I know Yinjie will talk about the performance of these funds later in the talk. But most of these funds, including Third Point, Pershing, and Starboard, have specific individuals associated with them. So in the case of Third Point, it's Dan Loeb. In the case of Pershing Square, it's Bill Ackman. And they are like the face of the company, of the face of the investment firm that goes after these companies. So they will get on the CNBC and start talking about how poorly management has done and how bad the stock performance is and how all their suggestions turn the company around. But it's important to recognize that these activist funds are getting larger and larger, and they're managing billions and sometimes tens of billions of dollars. And they can also use things like options to gain even more economic exposure to a company instead of just buying common shares. And that's a tactic that Pershing Square has used, I believe, in when they bought a position in Target a number of years ago. And this large size means that even big companies are not invulnerable, to activist investors. So this is an example, a recent example from a couple of months ago that showed how Elliott Management is going after Salesforce.com. And Salesforce.com is part of the Dow Jones Industrial Average. It's an extremely large company. And say 10, 20 years ago, you never would have thought of a company that large being vulnerable to activist shareholders. And the reason is because it takes a lot of capital to be able to buy a 5% position, a large enough position in a company like Salesforce to be able to get them to listen to you. So now that these managers have tens of billions of dollars, they could put $5 billion into a company like Salesforce, and Salesforce actually has to listen to their complaints to help turn the company around. And keep in mind that managers don't always agree that there are these problems there, and that can lead to these contentious fights that can lead to things like proxy contests. So one of the things that Victor mentioned is performance, and whether or not hedge fund activists sacrifice long-term performance for short-term performance. So for example, they come in, they enact some crazy change that temporarily lifts the value of company shares, and then in the long term, the stock price just continues to go down. Now, this is the best piece of evidence I can find that refutes that. There's a paper from only a couple of years ago that looks at hedge fund activism and long-term value, and actually shows that activism improves long-term value. So there is evidence to show that they're not just short-termists, they're long-term investors. And in many cases, even if they're not long-term investors, it still benefits shareholders. Another thing that has come about in the recent literature is benefits to peer firms. So for example, if I am an activist investor and I go after a software company, then there are improvements in returns for peer software companies, because the market tends to believe that, oh, well, you're going after this company because they have these problems. If a similar company has really the same problems, then I could be victim to that activist investor too. So the market kind of anticipates that, and the share price of the peers tends to go up. So there are some spillover effects that can result from hedge fund activism. So just to touch on my research, sell-side analysts do play a role in activists. If you're not familiar with sell-side analysts, there are very important parts of the marketing function of investment banks, and there are sell-side analysts in Cleveland and cities all around the country and all around the world, mostly in New York, but definitely not just there. And when an activist writes letters to shareholders or to the management or the board, they often use the content from the analyst reports to justify their tactics. So they'll say, look, I'm not the only person saying that your company is underperforming. The sell-side analysts that cover your company are also saying they're underperforming. And this is an example of EMC, large technology company, and how they were potentially mismanaging their investments in VMware. And they used quotes from RBC Capital Markets and Credit Suisse to demonstrate and reinforce their points. So hedge fund activists are really good at gaining consensus to support their ideas. And they can also do this through things like wolf pack activism, where they have multiple activists participating in an activist event. But when they see people who are saying similar things, they use it to reiterate their points. The last thing, and I'm close to wrapping up, that I'd like to share with you are some activism movies. I love movies. It's a lot of fun to Watch them, and it's a lot of fun when you can learn something about a topic, and you can learn a lot about activism by looking at these movies. They're three very different movies. The first one is Icon, the Restless Billionaire. This is on HBO. It is a documentary about Carl Icahn's life, and they speak about a number of companies that he has intervened with and his personality and how that fits into activist investing. So this is a very practical, it's very new, but it has a lot of history, and because the man's been doing it for 40, 50 years. If you want to go back a little further than that, these movies are now over 30 years old, but they're still really good, in my opinion. Other People's Money is a comedy type movie. Wall Street is a drama. Other People's Money stars Danny DeVito. If you've ever watched It's Always Sunny in Philadelphia, you might recognize him. And Danny DeVito's character tries to convey undervaluation of a target company through what's called sum of the parts valuation. And so he looks at the individual parts of the company, this business, cash on hand, assets, including a pension, and says, if I just take your company and I split up those parts, I sell off parts that are good value and I roll out parts that are undervalued, the breakup value will be worth more than what the company is valued at right now. And this is a very common investing tactic when activist investors target conglomerate firms that have multiple divisions that aren't generating good synergies. Now, Wall Street, there was another movie after the financial crisis called Wall Street, Money Never Sleeps. This is much better than that movie. It stars Charlie Sheen and Michael Douglas. The scene that is most relevant to activist investors is the scene that is famous for character Gordon Gekko saying greed is good. But he's actually engaged in a proxy fight to gain access to board seats on a company called Teldar Paper. And one of the things that he discusses when he's giving this speech is how many managers there are at Teldar Paper. So many managers taking on so many salaries, he can't even figure out what these managers do. So as an activist investor, he would say, well, get rid of these managers because they're not serving any function, and pass that cost savings on to customers. The topic that the movie is more well known for is trading on inside information, which is illegal. Activist investors cannot do that, even though they technically have the ability to move the market. They get that because of their own reputation and because of the returns to 13Ds. They're not technically insiders. Okay.
Thank you very much, Tom, for the excellent presentation. It's really exciting to learn more about activist investing, and especially the movies. So I never knew they existed, and I'll certainly take a look at those in the last couple of days, and things a lot of fun and very informative. And again, thank you for sharing your overall thoughts on all kinds of issues related to activist investing. So going next, I will share also some slides from my end to complement Tom's presentation. So it will be basically based for returns to the activist investors and one particular type of activism that's getting momentum in the recent years, which is the short selling activism. Okay, so I'm going to talk a little bit about the returns to the activist hedge funds themselves. So Tom already mentioned that from his perspective that the activist funds are doing a great thing to the firm, and the firms are definitely getting better. Okay, getting rid of redundant managers and having better performance, etc. But here I'm showing is the short-term return to the stock's price. Okay, so Tom already mentioned this, that the activist funds, the activists themselves have to file this 13D, Schedule 13D to the SEC when they own more than 5% of the company's stock. So this is the date that the public knows that a group of activist investors or one activist investor is going to target the company. So this is the day the news become public. And here, this blue dotted line represents how the stock price is moving. To be precise, it captures the buy and hold abnormal return around the filing of the 13D schedule. You can basically think of how the stock price is moving surrounding this public date. Okay, so you can see here is some momentum over here. The stock price goes up a little bit before the activist targeting event become public. So that is around 3% over here. And after the targeting event becomes public, we can see the stock price still goes up a little bit and all the way to 7%. So definitely there is short-term return to the activist targeting event. And here the red bars represent the abnormal trading volume. We can see there is a whole lot of abnormal trading volume before the activist targeting event become public. So presumably the activists are buying over here to accumulate more stocks in the company. And we can see even after the event becomes public, there are still some buying activities over here. Okay, one perspective or one explanation for the drive up in the stock price may be coming from this abnormal buying activity. So this is the event day return of the activism, which is also the short-term return to the stock. And next, I'm going to show you the long-term performance of the activist funds from the period 1995 to 2007. So here we have all three indexes starting at 100%. And the brown line over here represent the Standard & Poor's 500 indices. Okay, that's how it is performing during this period. Okay, increase to about 300%. Okay, in the middle of 2007. And however, when we're looking at the returns to activist funds, which is represented here by the dark blue line, you can see it is definitely outperforming the Standard & Poor's 500. Its total return reached over 900% in relation to what it has at the beginning of 1995. And the divergence sort of happened over here around 1990. Okay. As another reference or benchmark, if we're looking at the light blue line over here, that is the equity hedge funds index. Okay, so if you're looking at hedge funds utilizing equity as a strategy in total, this is the performance. And if we're looking at activist funds alone, that is the performance. So for this time period, it is definitely that the activist funds are outperforming the Standard & Poor's 500 and also the equity hedge funds in general. However, if we switch time period to more recent years, if we're looking at 2007 to 2019, now again, let's looking at the Standard & Poor's 500 index. So the green line here represents the return. And here, the light blue line and dark blue line represent two different activist index. So the HFRX and HFRI indexes. So these two indexes are similar and both capture how the return to activist hedge funds change over this time period. As you can see from this figure, overall, the Standard & Poor's 500 outperform the activist hedge funds. So this is for this particular time period. So for the fund themselves, they are not performing so well. And only if you are a high net wealth individual, you will not be able to access to the activist hedge funds. So hedge funds are only sold to large investors and individual investors with high net wealth. If you are an individual investor or a small investor, how will you be able to participate in this investment strategy? So there's one particular fund out there that is called 13D Activist Mutual Fund. So what this fund does is that once they have known that activist fund has targeted one company through the filing of the 13D, as Tom mentioned before, the activist hedge funds has to file Schedule 13D once they have ownership over 5%. So once that become public, this particular hedge fund, this particular mutual fund will take a look at those 13D filings, and then they will pick some of those targeted company stock that they think will outperform the market in the long run. So they typically buy in 20 days after the activist activity become public. So they will buy during this time period, and they will pick 20 to 25 stocks to hold in their portfolio. So as an individual investor, it will be easy for you to access this mutual fund. So the initial investment is relatively low. So here we can take a look at the return to this particular mutual fund. Okay, so the green line here represents its return, and the gray line here represents the return to the Standard & Poor's 500. Okay, you can see that from 2012 to 2016, or a little bit before that, the 13D activist mutual fund is outperforming, and it interact or collect with the Standard & Poor's 500 sort of after that, and overall it is underperforming a little bit. Okay, and throughout the whole time period, it is highly correlated with the Standard & Poor's 500. Okay, so if we're looking at this particular mutual fund that's following the activists to exercise a long strategy in firms that are being targeted by the activists, you can see there's not much of an excess return. Okay, and for a short period of time, there is one ETF that's tracking the activists. Okay, the Global X Guru Activist Index ETF. As you can see, it is underperforming the S&P 500, and it is sort of liquidated after a couple of years. So this is how this particular fund, following the activist hedge funds, is performing. Next, I'm going to talk a little bit about one particular type of activist investing, that is the short selling activism. So for the most part of time that mentioned or referred to, that is what we call long activism. Okay, basically the company, the activist fund will buy into the company and then initiate change in the company or demand change in the company, trying to turn the company around, makes the company better. And after the stock price goes up, the activist fund will sell the company's stock and then make profit out of that. And recently, there has been a reverse of the long activism. That is what we call a short selling activism. Okay, so what it is that activists, short selling activists, will strive to identify or allegedly overvalued companies, okay, in an attempt to profit from future declines in the company's stock price. Okay, so basically that is the reverse of the long campaigns. So instead of buying the company, they will first short sell the target company's share and then start a campaign and discredit the company through various tactics. So instead of trying to improve the company, the short selling activists will try to sort of destroy the company. Okay, and they will reverse the position after the stock price of the company decreased and then exit and profit. So that is the overall sort of situation of short selling activism. I've listed here some of the very famous short selling activists. We have Hindenburg Research, we have Viceroy Research, we have J Capital Research, etc. So some of you may have heard about the case of Lucky Coffee and some other cases that's being exposed, accounting scandals that's being exposed by these short selling activists. Okay, and I can also list a couple of other very famous short selling activists that's not here, including the Muddy Waters, Centrum Research, etc. So as you can tell from their name, most of them call them like research company. So what they will do is they will dig deep into the company's financial reports, dig into their operations, and find out if the managers are lying or not. So if are they making a material accounting fraud? Okay, are they not as good as they claim? Okay, they will then issue sort of so-called research report to notify the public that the company is not good as they are claiming. Okay, so these are the short selling activists. And as you can see from this figure over here, they're getting momentum in the recent years. There has been over 100 cases in the past decades each year. And we have seen over 200 cases in 2015 and 2016 worldwide. Okay, most of them are in the US, but we are also seeing cases in the Asia, Canada, and other countries. And lastly, let's look at how they are performing as an activist fund or for their strategy. So if we look at the 1 week campaign return, that's the event return, that's ranging from 4% to 7%. Okay, so that's comparable to the known campaigns. And if we're looking at the 1 month campaign return, that is ranging from 2% all the way to 12% for 2021. And obviously, all these short selling activists are performing well. So I will stop my presentation here, and that's all I have for the returns on the short selling activism and to the activist funds in general. Let me stop my sharing. And next, I will ask for Tom's review on several specific issues. So first of all, Tom, since we mentioned returns to the activist, can you elaborate a little bit more? I think you have already touched this already. On the criticism that activist investing is focused too heavily on short-term gains and may not be sustainable in the long run.
Well, I think, like everything, we can make generalities and say that, yes, long-term value is improved by activism, but it is specific to each individual situation. You can easily envision a case where a company that has what the activist views as an under-levered balance sheet takes on leverage to do, say, an equity repurchase, and then runs into trouble later and isn't able to survive because of the leverage that they took on during that activist period. So I think that we need to be careful, and we need to analyze the exact tactics that are being used and the trajectory for the company to get a better sense of whether or not long-term value is going to be delivered or destroyed.
Okay, so you mentioned that, so one way that the activists can create value for the firm is to get rid of redundant management. So can you comment on that a little bit, and maybe also share your thoughts on the potential impact of activism on companies' employees, customers, and maybe other stakeholders? How will they be impacted?
Yes, one of the questions in the Q&A is about how employees are affected by hedge fund activism. And there is one piece of evidence suggesting that employees are influenced in a negative way, and that is a paper in the Journal of Financial and Quantitative Analysis that shows that pension funds for employees tend to perform poorly and are underfunded following hedge fund activism. And that's just like the movie Other People's Money that I mentioned. The activist went after the pension fund because it was overfunded, and he saw that as an asset that he could exploit. So that is one negative way. In general, I think that hedge fund activists are looking to reduce costs, and reducing costs is generally not going to be helpful to employees. So I think employees, just like with private equity investors who are looking to reduce costs, are going to be ones that do not benefit from activism.
Okay, thank you, Tom, for sharing a review on that. Yeah, I personally agree with you to a large extent. I think activists are creating value for the firm by getting, reducing some of the costs associated with the firm. But of course, there were certain cases when they, as you mentioned, when the activists targeting pension funds and sort of issues, they may be sort of not being so, so generous to the employees and maybe some other stakeholders. Also related to that, so what do you think the roles that the activists can play in promoting environmental, social, and government issues? So probably there has been a trend that's called ESG investing. So does it has anything to do with the activists' activities?
Yes, I'm familiar with the one investor, I think it's engine number one, that went after Exxon and was able to initiate some positive ESG changes. I think it's difficult to launch an activist fund that is specifically focused on ESG because there's still a lot of uncertainty about whether ESG initiatives and ESG funds actually outperform the market or if they underperform. It's not like activist events that are clearly beneficial for investors. But I think that to the extent that other investors, such as BlackRock, that own large passive stakes in these companies, have ESG agendas, then activist investors can leverage those relationships to potentially use the blocks that those index funds and large passive investors have to gain more influence over firms. But it's still very nascent, and activist investors have to deliver returns. They can't just rely on ESG improvements for their end investors.
I think the focus for the activist funds are always return. So a lot of arguments can be made as to how ESG can benefit or increase the return of the firm, but personally, I do not see much of a concrete evidence that promoting ESG is going to, for certain, generate return for the firms. So I certainly agree with you from the activist point of view. ESG may not be a very promoting ESG may not be a very strong strategy to generate return. So that is also what I'm understanding. So can you also, moving to the next topic, can you also talk about what factors do you believe would affect the successfulness of the campaigns? So is it important for the activist investors to pick the right target? And also maybe can you comment on what type of companies or industries are most susceptible to activist investing?
I think the most successful activist investor campaigns are situations when management is willing to listen to the activist investor because it lends to lower cost. If you engage in very, very costly fights, then that's going to reduce the returns to activists. It's actually going to make activists less likely to come in and take a position because they feel as though it's not an easy target. So I think there are situations where maybe a manager wants to make changes but doesn't feel compelled to do it, but then they're very receptive to those changes once the activist comes in. Those would probably be more successful in my opinion. Yeah,
I think that's certainly what I'm thinking also. So I think to reduce the cost of the campaigns is definitely one big factor that's influencing how successful the activism event can be. So we have one question coming in the Q&A session, and also related that what we're just talking is that, so how widespread is activist investing, and do you know of any Northeastern Ohio companies that were targeted by the activists? So as you know, Cleveland State University, we're here in the heart of Cleveland, and we have a lot of companies surrounding in the surrounding area of Cleveland. And Cleveland used to be an industrial city, most famous for manufacturing for automobile companies. And nowadays, as we have been referred to, the Rust Belt, some of them are not performing well. So can you comment on that situation a little bit?
So activist investing is very widespread, and you can see it by the huge amount of money that activist investors manage. Specifically to Northeastern Ohio, while Yinjie was speaking, I looked up activist investors through a platform called Capital IQ, and some of the firms in the Cleveland area that have been targeted include Middlefield Bank Corp, Heister Yale Materials Handling, Aethersys, E Corp, and TransDigm Group Incorporated. Those are in the last 3 years. And if I go back even further, there's companies like CBiz, Parker Hannifin Corporation, and NACO Industries. So even in the Cleveland industry area, there have been multiple firms that have been targeted by activist investors.
Okay. Thank you for doing that research and finding all these events that's happening around Cleveland. So as personally I know, we also have some activist hedge funds that's located in the surrounding area of Cleveland. So that's not quite common, as most of the hedge funds are located in New York or in the West Coast or in Chicago. But we do have some very influential activist hedge funds here in the Cleveland area. So Ankara, for one example. So following up on that, can you talk or comment on the defensive strategies from the company's perspective? So if you are the company's manager and you sort of having the potential or the threat of being targeted by the activists, so what can you do ahead of being targeted, or what can you do sort of in a defensive posture to sort of prevent activists investing from happening?
A lot of the things are done before the companies even targeted. Poison pills, dual class structures are set up long before the company is targeted by an activist, often when they go public. So I think that the most valuable thing for a manager to do is not be silent, to engage in conversation, to be open-minded. If you feel like you're on the right course, like might be the case with Mark Zuckerberg and the Meta investments, then communicate that with investors. Explain why your investment strategy is going to lead to great returns for shareholders, and what the activist investor is explaining is wrong. And often you'll see that public dialogue. You'll see the activist investor send the company send a letter back to the activist investor, or go on CNBC and talk about all the great things they've done. But the key thing is going to be share price. Share price is going to respond to whatever positive things come from the activist investor. So if there is a big return to a 13D filing, it suggests that management's usually not on the right path. So if the worse the return is on the 13D, the more confidence the market has in the manager, and vice versa.
Okay, yeah. So I certainly agree with you that the managers need to communicate with their investor base more often than they are doing now, and probably they should do some of the things that activists suggested even before the activists suggested. So, anticipate what should be done to improve the value of the firm, and maybe boost the stock price, so that the general investors will be happy about the firm's current management, and so they will see a less event return for the activist targeting campaign. So following on that, can you sort of comment on something what we call a wolf pack, meaning that a bunch of activist investors will work together or collaborate with each other to get into one campaign to increase their sort of chance of success?
Yes, I mean, it's exactly what it sounds like. Wolfpack investing is essentially multiple activist funds coming together, each taking a smaller position in a company and using that combined position to enact changes. So it's potentially beneficial because it's multiple voices that are saying you're not doing the right thing. So it's a credibility mechanism, it's a signaling mechanism, and it's a resource allocation mechanism for funds that don't necessarily have the ability to buy a large position by themselves, but can do it with a combination of other activist firms.
So I think, do you think that would have contributed to the recent trend that activist investors are targeting more and more bigger and bigger firms nowadays?
Yes, I think that those are related.
Yes, for sure. So I think you mentioned Salesforce, and in the past, I think Google and Apple, they all have been targeted by the activist investors. So moving to our next question. So what's your review on the role of government regulation in activist investing? So do you think there should be limits to the extent to which activists can influence the corporate decision-making, or do you think we should trust in the invisible hand of the market and let them do what they are good at?
It's a very difficult question to answer, and especially given my position within the Securities and Exchange Commission. I am not speaking for the commission when I say this, but there does need to be regulation, and it's in part because of what's mentioned in the chat. Activist investors have a lot of power, and they can manipulate things. There was a lot of controversy around Elon Musk and his acquisition of Twitter when he filed and said, I have this position, and then he says he's going to take the company public, but then he says he's not, and then he says he is. So if you have the view of the market on you as an activist investor, and you're doing things that are potentially misleading other investors, then regulation can be a solution for that. And I think that we do need to have certain rules and guidelines around activist investors to help this process.
Sure. Yeah, I think you mentioned misleading and market manipulation. I think one of the questions that you're referring to from our audience is that the so-called short-selling activism sounds like market manipulation because the claim in the reports doesn't have to be true for the short sellers to profit. Can you comment on that a little bit?
Well, anyone can say anything that isn't true and try and influence the stock price of a company. If I say something about a company and it's negative, it's not going to drive down the stock price because I'm not Hindenburg Research. Hindenburg Research, the reason why they're able to generate those types of negative returns on Square is because they've been right in the past about activism. So it's not necessarily about what they're saying being right or wrong. It's an opinion about the company. It's about their reputation. Their reputational capital is what's driving the stock down. The reputational capital of long activist investors drives the stock up the same way. So you have to have credibility to be able to move markets with information. And some investors have that and some don't. To the extent that they're manipulating the market, if they're being shown to consistently deliver false information to the marketplace for their own means, then that is going to be considered market manipulation and it could get them into trouble.
Okay, I certainly agree with you. Reputation plays a huge part in generating return, at least short-term return for the activist investors. So I think we have seen known campaigns for more than 2-3 decades now, and a lot of firms, hedge funds, or specifically the figure individuals, prominent individuals like Carl Icahn, Bill Ackman, as you mentioned, have accumulated quite a reputation as the activist investors. So that's playing to the overall performance of the activist funds. So moving to our next topic, and you mentioned at the beginning of your presentation related to artificial intelligence, and machine learning sort of technologies. Can you comment on the role of technology in activism? So how has the technology changed the way activist investors operate, and what new tools and strategy are emerging in this field? So basically, I did a little bit experiment last night. So I tried to ask ChatGPT which company would be the next target of the activist, and ChatGPT told me that it's a language model and it cannot tell me who will be targeted in the in the future. So, but I suppose there will be all other kinds of technology that's being utilized in recent years. Can you comment on that a little bit?
It's still a very qualitative strategy. It's not. It is largely about strategy, communication. I think that the ways that technology plays a role in activism right now are the screening, how activists get access to a list of potential candidates, and how they use technology tools like the one that I use to find activist targets in Cleveland. Those are really helpful. I think they speed up the ability of activists to find good targets. But I think that the communication platforms are also really important. Most activists have websites that they use to communicate their letters to management. Some of them even start specific websites for specific campaigns. There was one that I renewed the domain because it had a previous campaign, because I was interested in activism a long time ago. So I think that it's not about putting a bunch of data into a system and coming up with a strategy. It is about filtering down targets and communicating with investors. That is how technology has changed activism.
Thank you, Tang, for your thoughts on that issue. So I think we are approaching the end of this session. For our last question, so I would ask you to provide some advice to individual investors or small firms who are interested in engaging activists investing themselves. So do you have any thoughts on that? Maybe as an individual, how we can maybe profit out of this investment strategy or this trend is going in the market?
I mean, I think the best way is to look for broken companies that have a possibility of being fixed. So think about a company that has problems that if you came in as the CEO, you could solve pretty easily. If you can find companies like that, chances are they're going to become targets of activists. And they're not as easy to find as they used to be, but I think that generally those opportunities are more easily found in small cap stocks because that market is less scrutinized and just it doesn't have as many eyes on it as large cap stocks. And chances are, if you have an activist investor and they came in and you wrote them a letter, they might actually use it, which is not going to be the case with somebody like Elliott Management or Pershing Square or Third Point, because they're targeting very large companies and they're relying exclusively on their own expertise.
Thank you so much, Tom, for all of your insights and for being with us today. And also, a big thank you to our audience. And we're approaching to the end of the session today. And I would like to mention that we do have another Cornerstone speaker series coming up on Thursday, April 27th. And the topic is Diversity, Equity, and Inclusion is a Strategy. The discussion will be led by Jim Collar, Director of our Sports and Entertainment Management Program, and Kevin Clayton, Senior Vice President and Head of Social Impact and Equity for the Rock Entertainment Group. We hope that you all will join us for that webinar as well. Thank you again, and have a great day.